All right, let's get right into it. In the business world, there's one word you hear constantly: growth. It's treated like the ultimate goal, the number one sign of success. But what if I told you that our obsession with growth is, well, it's a trap? What if chasing growth for growth's sake is actually one of the fastest ways to destroy a company's value?
And that's the big question we're going to tackle here. Because honestly, the answer is not as simple as it looks. You've got some of the fastest growing companies out there that are basically on a treadmill to nowhere, while other, much slower companies are quietly creating incredible wealth. How does that work? Well, we're about to find out.
So, let's kick things off by busting the biggest myth in business, the idea that growth is everything. You know the drill, we see it in the headlines, we hear it on earnings calls. If you're not growing, you're dying, right? Well, maybe not. Yeah, this idea is so deeply burned into our brains that we automatically think that more sales or bigger profits equals more value. But that's just not always true. In fact, focusing only on that top-line growth can steer a company way off course from what actually makes it a valuable business. Okay, check this out. This is a real-world puzzle. We've got two very different companies here, tracked over 2 decades. First up is Costco, a retail machine, growing at a crazy pace. Its profits shot up 9 times over. Then you have Brown-Forman, the folks who make Jack Daniels. You can see much slower, steadier growth. But look at that bottom line. They both delivered almost the exact same 15% annual return to their shareholders. How on earth is that possible?
And that is the question that blows the whole growth myth wide open. I mean, if all that super fast growth didn't give Costco a real edge in shareholder returns, then something else, something much more powerful, has to be going on behind the scenes. And you know what? There is.
The hero of our story, the secret ingredient, is a little metric called ROIC. That's return on invested capital. Just think of it like this. For every single dollar a company puts into its business, building new stores, buying equipment, all that stuff, how many cents of profit does it get back each year? That's ROIC. It's not about how much you grow. It's about how well you grow.
And this chart just says it all. Brown-Forman had an incredible ROIC of 29%. So for every dollar they invested, they got 29 cents back in profit every year. Costco's ROIC was a totally respectable 13%, but that's less than half of Brown-Forman's. See, Brown-Forman didn't need to grow as fast because every dollar of its growth was more than twice as powerful. Okay, so this brings us to myth number 2, the idea that if two companies are earning the same profit and growing at the same speed, they have to be worth the same amount of money. And again, you'll see the reality is way more interesting than that. So, let's cook up 2 imaginary companies. We'll call them Value Inc. and Volume Inc. On paper, they look like identical twins. They both make a cool $100 million in profit, and they're both expected to grow by 5% a year every year. Conventional wisdom would tell you they should have the exact same valuation. But here's where the stories diverge. Now, don't worry about reading every single number in this table. Just notice the top line, net operating profit. It's identical for both. But now look down at the investment line. To get that same growth, one company has to pour way more money back into the business than the other, and that leaves it with a lot less cash flow at the bottom. And that's the key. Okay, let's break it down. To get that 5% profit boost, from $100 million to $105 million, our efficient company, Value Inc., only needs to reinvest about $26 million. But Volume Inc., it's a capital-guzzling machine. To get the exact same $5 million in extra profit, it has to plow $53 million back in. That's twice as much. And that means Value Inc. has a whole lot more cash left over for its owners at the end of the year. And what does this all come down to? You guessed it. It's their ROIC. Value Inc. has a really healthy 20% ROIC, while poor Volume Inc. is stuck down at 10%. This one number explains the entire difference in how they perform and, as we're about to see, how they're valued. So what's the punchline? Despite having the same profits and the same growth rate, Value Inc. is worth a jaw-dropping $500 million more. That is the incredible power of being efficient with your capital. And that leads us perfectly into our third and maybe the sneakiest myth of all, this idea that you can use clever financial tricks to create value out of nothing. This is the world of financial engineering, and it's basically built on a house of cards.
Here is the fundamental rule you have to remember. It's a core principle in finance, sometimes called the conservation of value. And it's so simple, yet so powerful. If it doesn't increase a company's real cash flows, it doesn't create real value, period.
And you see these illusions everywhere.
Things like share buybacks that just make the earnings per share number look a little better without improving the actual business. Or mergers that are justified with some fuzzy math about how the new, bigger company deserves a higher valuation. Even simple accounting changes. All these moves are just different ways of slicing up the same pie. They don't make the pie itself any bigger.
And here's the thing. Over the long haul, the market is pretty smart. It's not easily fooled by this stuff. Investors reward companies that actually generate more cash, not the ones that are just good at shuffling paper around. Real value has to come from something tangible.
Okay, so we've busted some pretty big myths. Growth isn't always the answer, and not all profits are created equal. So what do you do with this information? How can you actually use it? Let's build a little strategic playbook.
Now, this chart right here is the key. It shows us whether it's smarter to chase more growth or to focus on improving your ROIC. For a company that already has a high ROIC, over on the left, you can see that just a 1% bump in growth adds way more value. But for a company with a so-so ROIC, over on the right, a 1% improvement in ROIC is the much bigger win. It all depends on your starting point.
And this isn't just some abstract theory. This is a clear, data-driven roadmap for any manager or investor. It tells you exactly where you have the most leverage to create value. There are two different paths, and you really need to know which one you're on.
So here's the playbook, plain and simple. If your company already has a fantastic ROIC, your number one job is to grow. Your engine is already humming along beautifully. It's time to hit the gas. Every dollar you reinvest creates a ton of value. But if your company has a low or just a mediocre ROIC, chasing growth is a huge mistake. It can actually destroy value. Your top priority has to be fixing the engine first, improving your efficiency, and getting that ROIC up.
So you see, the big takeaway here is that it's not a choice between growth or quality. It's not growth versus ROIC. It's about the smart combination of both. The best companies know exactly which lever to pull and when. They know if it's time to hit the accelerator or if it's time to head back to the garage for a tune-up. And that leaves us with one last question. Something for you to think about. Look at the company you work for or the stocks you own. Are they just chasing growth for the sake of it, or are they actually building real, sustainable value? The answer to that question could make all the difference.